What's up, Judah?
Not much, man. My sister's calling me right now. Apparently, she doesn't know that I do a Facebook Live at noon every day, but I am glad that our dear listeners know that we do a Facebook Live every day at noon. I will have
Mm.
to talk to. You know what? My sister is a financial planner with Edward Jones. If we ever get into those type of topics, she might be somebody that we should have on here.
That's a great idea.
Yeah.
That is a great idea. Okay.
So,
Yeah.
dude, we were supposed to be like cloudy and overcast today. It's kind of sunny. I'm looking forward to going out back in my backyard and working today. What are you doing today, Josh?
Well,
Are you in your basement? Your office has a very shut up in your basement, away from your wife and kids feel to it. When your kids aren't traipsing
well,
through the background.
I'll tell you what. My days are crazy. Like COVID has done the opposite for me than the rest of the world. Like
Correct.
my day starts a little bit later, because it ends up, going a little bit longer. But
Right.
I find myself like, I'm jumping from platform to platform. I mean, I spend probably half my day on LinkedIn talking to people and either on the phone or analyzing deals. So,
Dude, that's got to be one of the other things that we do. We have got to have a show or a week where you teach people how to do LinkedIn, how to prospect with LinkedIn, and how
look,
to, because so many people use Facebook and so many people use and see Facebook. They consume a lot of Facebook, so it comes very intuitively to them. I
look,
think that LinkedIn would be good to do some actual training on how to use it best. Would you be down for that?
100%. And you know what? LinkedIn is great for certain things. Certainly business to business, and in my business it works well because we're dealing with a lot of professionals as borrowers and as lenders and things like that. On generating leads for like motivated sellers, it's kind of tough. Yeah. Jonah Hoover.
Oh, there's my sister Shauna.
Yes,
He's the
yes.
one who I was just
I'm
saying.
sorry. We're just talking about you.
We were just talking about her. She was calling me at noon. So that's great. We will have to have my and by the way, she's a great Facebook follow. If you want to reach out to and Facebook follow her. So today on today's show, Josh, I mean we've got so much content. We've got to jump right in here. So we're going to be talking about the relationship that lenders have with borrowers. Now, don't roll your eyes because this is actually going to be new information for a lot of people, and it's different than how a lot of people think about it. Usually on this show, just by very nature of it, we have a very much a 101 level understanding of what we talk about, and then we also talk about the news. Today we're going a little bit higher. We're digging deeper. We're going with some 202 level stuff, and we're going to talk about the balance between lender and borrower and the relationship that they have with each other. And a lot of people have a lot of misunderstandings and misconceptions when it comes to the lending world when they transition from residential to commercial lending, and they say, oh well, that's not normal, that's not real, that's not that's not how things normally go. But here's why: because most consumers, when they first step into the consumer world, when they first get their first hard money loan or whatever, most consumers, when they step into the commercial world, their experience up to that point has been with 30-year fixed residential mortgage backed by Fannie or Freddie, which is essentially the federal government. And they don't realize that throughout the 5,000 years of human history, 30-year fixed mortgages were not a thing. It's only been in like the 70s and 80s that that's really been a thing. And so we think the most, like, number one, our past experiences, and also the 5 to 10 people who are closest around us. So if the 5 to 10 people around you aren't active real estate investors who have talked about this, and you haven't done a bunch of previous commercial loans, you don't understand that we're really spoiled when it comes to the modern day residential loan in North America. And it's fine for what it is, but it bears no resemblance to what typical lending parameters are and the typical relationship to borrower and seller. Is that or borrower and lender? Is that a pretty good setup for what we're talking about?
It absolutely is. But here's why it's important if you're a real estate investor, right? Here's why it's vitally important. Whether you're going and talking to a hard money lender or you're raising your own private capital, if you understand this part of the equation and like the underlying principles, the whole business on both sides, it makes so much more sense. And, especially if you're raising private capital, you're able to talk to an investor and say, hey, look, I understand your concerns. Here's how we can address them. And I understand, that this is what your objective is. This is what you're trying to get out of the deal or out of the transaction. Here's how I'm going to give it to you. And by understanding that, it just puts you in a better position to have a meaningful conversation with a lender. Or, if you're thinking about investing in private mortgage notes or something like that, kind of gives you a different perspective on, hey, this is kind of something that I should be worried about. Here's how I can mitigate that risk if I'm thinking about doing that. So yeah,
Absolutely.
I mean, that's good. All right, so let's jump in here. I mean, this is I entitled this, risk and reward in a world of government oversight. Go ahead.
And the government oversight is the big deal there. I was a fully licensed mortgage lender, not just a mortgage broker, but a mortgage lender for about 15 years. And the joke we always said was, if you want to be in a less regulated industry than the mortgage industry, start a nuclear power plant.
Yeah, not much regulation there at all, right?
Right.
All right, so let's dig in here. We'll I always love starting with a quote, and we've got the king of investment here, Warren Buffett. Like, rule number 1, never lose money. Rule number 2, never forget rule number 1. Right.
It was that was the Fight Club quote before there was Fight Club.
Right.
That's in Omaha how they say rule number 1 is do not talk about Fight Club. Rule number 2 is do not talk about Fight Club.
That's right. And I mean, this is a great backdrop, because if you look at a loan, as a transaction, right? There's two sides of the transaction, and both people have not conflicting, but different points of view and different motivations. They've got different objectives, they've got different roles, and they have different risk levels. And actually, in a balanced transaction, there's no difference in risk.
Right. Risk is the same.
Exactly. You're
sharing, but the risk originates from different places.
That's right. That's right. So let's first talk about what is a loan. I mean, this sounds really stupid, but in order to really, frame the conversation, it's important to understand what we're talking about here. A lot of times people don't even think about what words mean. So we got to define them. All right. So in this case, we're talking about, this is an agreement between two like parties, right? Let's say an independent lender and an independent borrower that agree that they're going to enter into this agreement, and the borrower is going to lease the money. They're going to rent it for a certain period of time. And what they're renting is future income. It's money that they're going to make in the future. And in exchange, they're going to pay some fees and charges and interest and all that kind of stuff. Right?
It's funny that you talk about it as renting the money, because there's certain people of certain religious groups that their holy book says that any interest is essentially usury and not to charge each other interest. So they will not charge interest, and they eschew all debt, but they are willing to rent each other money.
They are willing to what?
Rent each other money.
Oh, right.
They don't charge interest, but they rent each other money. It's basically the same thing. Think of it as you are giving somebody money and you are renting that to them. Just like we as real estate investors rent somebody square footage under a roof called a house, we rent somebody capital and call the rent interest.
There we go. So I put this scale, this balance in here, because I thought this was really important to understand this relationship, like visually, right? We've got, on one side, we've got the borrower's objectives and intent, and the other side, we have the lender's objective and intent. The borrower, they're going to use other people's money, OPM, to leverage their capital. And that means if you have $100 and you leverage it 10 times, that allows you to buy $100 worth of value, right? So that's essentially what that is. And then the lender, their objective and their obligation, their role here is to lend the money. Pretty straightforward. In exchange for other people's money, the borrower, they're going to pay fees and interest. Again, pretty straightforward. The lender, in exchange for their role, they're going to get fees and interest on the rent to rent their capital.
Right.
And then how do we secure that? Like, we're going to go into this a little bit more, but like, the borrower is going to secure that other people's money by providing an asset
Right.
as collateral. And on the
I
flip
will
side,
give you back this money, and if I don't, you can have this asset. And the lender then says, well, I don't think that that asset is enough, or for that asset, I'm only willing to lend you this much money.
right, exactly. So then, I mean, really, we're talking about the same conversation. It's the same action, but depending on the perspective of your role in that transaction, it really changes how you're viewing it. And this is going to be a little bit more of a little bit more insightful. So, lender, we talked about the role. It's to provide liquid capital to the borrower. Really simple. Their motivation. This is this is really an important part of this. Why are they doing it? They might be a nice person, but that's not their objective, right? I mean, their objective is to earn a passive return. They don't want the property. They don't want to have to swing a hammer and, develop that asset. They're going to get a passive return in fees and interest on the money that they've deployed, right? Now comes the risk part. And if you think about it in this way, like the fees, let's say they're a really expensive lender, right? And they charge 25% interest.
Phew.
Yeah, crazy, right? On a $100,000 loan, that's $25,000 a year. It's going to take them 4 years to get to double their money.
Right.
The risk here is the loss of $100,000. They're putting $100,000 out there at risk to make $25,000 a year. And the reality is, we're probably talking, on normal lenders, you're probably talking anywhere from 4 to 15%, depending on the type of lender and things like that. So that is a heck of a lot more a risk. So they've got to mitigate that risk. They've got to find a way to offset that risk. And how they do it, they're going to underwrite the borrower first. They're going to confirm that the borrower has the ability and the intent to pay them back. That means, in ways they do that, they're going to look at the character, which, is going to be their credit score, their track record, the money they have in the bank, things like that. And they're going to require them to have skin in the game. Right?
Right.
All right.
So skin in the game, either in a purchase by in a purchase, that skin in the game comes through the form of down payment. In a refinance, it comes in the form of not lending to 100% loan to value. In a hard money loan, that skin in the game comes from not advancing for work to be done. I'll lend you, if it's a $20,000 rehab project on a $50,000 purchase, I will give you $50,000 to do the purchase, but then I'm going to take this $20,000 over here and I'll give you chunks of it only as the work is done. So your skin in the game comes in the form of sweat equity, or else a credit that you've extended to the contractor to get the work done.
That's right. And then the other way that they're going to,
it's important to realize that skin in the game does not always mean bringing a check to the settlement table.
That's right. Oftentimes it does. I mean, and you know what? A lot of times it depends on the part of the real estate cycle we're in.
Right.
When prices are continually going up and up and up and up and up, that skin in the game might just be finding a really great reduced price property.
Your hard work, your sweat equity into, maybe you didn't sweat while you were sending out those mailers, but your intelligence and your work and negotiation skills to get a good deal.
Exactly. Now, on the flip side, they're like underwriting the borrower and analyzing them. That's just one part of the equation, because they could get hit by a bus. Like, God forbid, but they could get hit by a bus. So you got to underwrite the collateral as well. Is the asset that's being pledged against that loan, is the asset worth what we're lending at least? And how are we going to secure that? In some cases, if you're dealing with gold or you're dealing with assets that can easily be moved around, sometimes the lender will place them in a physical escrow, like in a bank vault. Other times we got real estate. You can't very well put that in the bank vault.
But what you can do is you can take out a mortgage on it.
That's right.
It's not like a car loan where the lender holds the title to the car, even if it has your name on it, they still hold on to that title.
Yep.
They record a mortgage, which is a document that ties. So there's the promise to repay, that's called the note, and then
Yep.
over here there's the deed that says who owns the property. The mortgage is in between, that is what ties those two things together. And there's an important thing here that I also want to point out to you here. Josh, you mentioned about underwriting the borrower. So in a typical loan, there's two things that you need to underwrite. Is this property worth what I think it is? Is it in the condition that I think it is? What's the real estate market like? Like, you have to look at the real estate. You also then have to look at the borrower. How steady is their job? What's their credit score? Blah 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 blah. In a in a in a in either a 203k loan, like for FHA, rehab loan, or a private money loan or a hard money loan, there's a third element of risk, and that's the contractor.
Yeah.
Could the contractor get hit by a bus? What kind of work has the contractor done in the past? Show me the scope of work that's going to be done here. So if you take anytime you have two variables and you add a third variable, you have increased the variables by 50%.
Right.
That is a huge amount of risk that the lenders have. That's why it goes from 5-6% to 10 to 15%. That's why the loan to value goes from 100% down to 70%, because there is so much more risk associated. I was a hard money lender. God bless you, Josh, for doing it. And people just don't understand. They think, oh, you're getting 5 points and 15% interest. You must be driving a Maserati. Not really. I got a lot of risk I'm sitting on here.
Well, and that's the whole thing about the scales, right? When the risk increases, you've got to do something to balance out that risk. It's the risk reward balance on both sides of the equation. It would not make sense. It would not make sense for a borrower to go and buy a retail property at full market value and then get a very expensive loan against that property at a low loan to value. Right? Like, if you got a beautiful retail property, you can go out and get a conventional loan. And then, we'll get into that in just a second. I wanted to mention at this point that, we are giving away, if you're commenting, we'd love you to be part of the conversation. We're going to pick out a comment every day, and we're giving away a free copy of Property Hackers to anybody that is, on the show and providing some
That
comments.
sounds like an interesting book, Josh. Who wrote Property Hackers?
I did. It's yeah. There we go. I got a stack of them behind me. We got Steve Carney and oh my gosh, Taz. I see you on here. I just wanted to. I keep wanting to say Taz, and I know that's not your real name, so I apologize. It's Jameek, right? Yeah, I think so. Okay. So anyway, now we go on. Now let's talk about the borrower, right? The borrower has totally different motivations and a totally different perspective on this, right? Their role is they're going to borrow the liquid capital, they're going to pledge an asset, and they're going to pay the fees and interest. That's their role in the transaction, and that's great. Their motivation's a little bit different, right? They want to limit their personal risk, and that's one of the reasons that they're taking out the loan. They want to also get control of an asset. So they want to use leverage to control an asset that's much greater than the capital, than the actual cash that they're investing here. And yeah. So, I mean, in the case of real estate, it's one of the very best places to invest because you can utilize that leverage. And
right. Real estate can be leveraged at, 70, 80%. Gold, good luck getting somebody to lend you on gold above 60%.
Right.
I mean, just think about that. Real estate is more leverageable than gold is.
And in the typical stock market, there's no leverage. I mean,
right.
It's possible, but it's not likely.
Yeah, you can do leveraging. So real quick personal story. So I had a business mentor, Bruce Barlar. I was in my early 20s. He was significantly older, and he's still a good friend of mine to this day. But he was kind of the old wise one. I was the young. What's that?
Bruce is
Yeah.
awesome.
Yes, you
Yeah.
know Bruce. Yeah. So
Yeah.
Bruce
Yeah.
taught me so much in real world. And like when I was in my early 20s and I was learning about all these different, higher level ways of investing, and I learned about option calls. It's basically how you can leverage stocks. And I was like, Bruce, we could do this and we could do this because we had, hard money on the street. And I was like, Bruce, let's do this and let's do this. And look, we can make all this money. And Bruce just said to me, he said, Judah, about 4 years ago, I made $100,000 trading options. So I know all about it. I said, really, Bruce? He said, yeah. That same year, I also lost $200,000 trading options.
Yeah. That's really funny. Bruce
so you can lever stocks. It is just highly risky.
Oh yeah, Bruce just closed a refi for my parents. That's how he's a great guy, and we've had great conversations. But anyway, so the risk on the borrower relative to the lender, it's not nearly as high, especially if you're looking at a conventional residential loan, and we'll get into that in a minute. But what are their risks? They could lose their capital investment, their down payment, the money and time that they have invested, the skin in the game, right? You could also they could have the loss of the asset that they're pledging, right? And then they could damage their reputation, credit, all that kind of stuff. So how do they offset that risk? What's the mitigation there? Nothing. Come on.
Okay. You're doing a great job. I'm following along, man. You're the play-by-play guy today. I'm just the color commentary. Keep going, Josh.
Think about this. In a perfect world, as a borrower, what do you want? You want a loan that is 100% of the asset.
Financing, zero interest, no payments. Don't call me or send me a Christmas card.
That's exactly right. Huge loan to value. So they want to get the greatest amount of leverage that they can on that with the least amount of their own personal capital invested in the asset. Number two, they want to manage. They can manage the property, both like the renovation, the cash flow. Make sure they're picking out good tenants, all that kind of stuff. They can manage the asset to make sure it performs, and then it's providing profit for them. And then the third part is that they can limit their guarantees. So like if there's no personal guarantee on the property, what that means is, we talked about this a little yesterday, with larger dollar amounts, a lot of times, the leverage on the property or the loan, it's really based on the value of the asset and not on the borrower themselves. Sometimes on a $3 or $4 million loan, you won't even have to provide your credit. They just want to make sure you don't have a bankruptcy recently or something like that. Right. So that's a great situation, but they're also loaning at a much lower loan to value. And you've got a proven track record with the asset itself of cash flow and money coming in and things like that. Whereas on a single family home, if you got one tenant that's not paying, you have zero income, right? So that's a lot more volatile. They're going to require more skin in the game, and they're probably going to make you personally guarantee those loans.
Yep.
All right. So this is where the fun part comes in.
Because this is today.
Yeah. Typically in a normal market, you've got the balance, right? You have the lender who is providing a service for a fee with some risk, but also they've got a check and balance. Today, we have 4 parties involved. The one that has the most amount of risk is hardly even in the equation. So let's look at this. If you're looking at a consumer loan for a residential property, and let's pretend it's a first-time home buyer FHA property. Judy, do you know what those rates are now? Like what the loan to value is 3.5% down?
Yeah, 3.5%.
Okay. So the borrower has to put 3.5% down. They're putting $3,500 down plus closing costs on the property. They've got very little money in the deal. Right? The bank is going to use somebody else's money and then leverage that money to give you the loan.
Right. The bank lends you their money, but they lend you their money based on what they know they can sell before the ink dries.
That's right. That's
And
right.
and many people think this has always been my favorite thing when people are like, "Oh, my bank didn't sell my mortgage." Yeah, they did. They sold your
Yeah.
mortgage before the ink was dry, and they probably sold it 30 days before the ink was dry, actually. And they sold it based on what somebody else's underwriting standards were. They just retained the servicing rights. They
Right.
just carve off between $5 and $10 a month of the monthly payment that you send them every month, and they send the rest to some shadow figure in the back called the secondary market.
Right. Right. So that's happening. Well, how is that possible? Why does the bank not care? Well, the bank doesn't care because you've got a third party, you got the government, who's putting their thumb on the scale. They're tilting the scales for the benefit of their borrowers. And who are the borrowers? They're the voters. They're
Right.
taxpayers. And frankly, I don't think it's necessarily a bad thing because a strong base of home ownership is really important for communities and that kind of
We
thing.
as a society decided to encourage home ownership
That's
and
right.
spread that risk across the federal government and thereby the U.S. taxpayers. And we decided to make it easier to buy mortgages. It
That's right.
started with FHA, it started with VA, with the returning war vets. And then basically the rest of the banking world said, well, if we can do this for our vets and look at that it's been a good thing for our vets,
That's
we
right.
should also do this for everybody else.
That's right. Yeah. So I mean, there's a lot of really good reasons why the government stepped in and encouraged that homeownership and provided that liquidity. I mean, however, there's been some blowback and there's been some offsets here that you've got to understand if you're thinking about investing. And the first one of those is that the real lender is not involved in the equation at all. They're buying a securitized part of a pool of these mortgages. And most of the time, if you look over the last 70 years, the percentage of default is really, really low.
Right.
The problem is right now we have 4 million people who aren't paying their mortgage.
Right.
The problem is in 2008, we had a ton of loans that went bad. And now these securitized debts are not so beautiful. Like the returns all of a sudden are not great or terrible. And in some cases, you have lenders losing their entire investment for what, a 4% return?
Right. And I think that, do you remember that movie Black Hawk Down?
Yeah.
Did you
Yeah.
see that? So the U.S. military is oftentimes criticized because of their failure missions, right? But
Yeah.
that's human nature. Black Hawk Down wasn't the first time that we sent too few guys to do the mission. It's just the first time we got caught. And so the U.S. military does a bigger mission with slightly less guys, a bigger mission with slightly less guys, a bigger mission with slightly less guys, and eventually we get our asses kicked, even though we shouldn't, because we're the biggest, strongest military in the world. The same thing happens in the lending world. We take a little bit more risk and don't get caught. We take a little bit more risk and don't get caught. We find more ways of injecting liquidity into the system and nothing goes wrong. But then when it breaks, it all comes down. It's not necessarily because of fraud. It's not necessarily because of deceit. It's not necessarily, sure, in hindsight, we can see that things could have been done different, but doing more with less than we did last time is human nature. Think about you on your way to work. Unless you're like a diagnosed OCD person like Josh, you wake up a little bit later and rush a little bit more. You wake up a little bit later and rush a little bit more until you meet your boss at the door at 9:02 one morning and he's wagging his finger at you.
Right.
And then you start, and then you reset your clock 30 minutes, and then you play that game over again. So the real estate market does the same thing with lending: more with less, more with less, more with less, and eventually a black swan event like a national shutdown with the excuse of a quote unquote pandemic comes along, and it resets a lot of clocks.
Hey, Judah, but what's really funny here is what's the reset? The reset is 20% down.
Right, exactly. Right.
That's not too bad of a reset. That's a pretty doggone good thing. I think the thing that has scared me over the last couple months is the increasing number of not defaults, but what's the word they're using? I keep forgetting it.
Forbearance.
Yeah, forbearance loans, right? And the impact that it has on the banks who end up being the servicers. because what they end up doing is, or where they end up getting caught, is that with those forbearances, I think I saw the number that like the entire industry was worth about $20 billion a year in revenue, gross revenue, not profit, right? But the cost of the deferments was something like $120 billion over like a 6-month period. So I mean, it dwarfed the revenues and could have caused a collapse. But I mean, I think we're kind of on the other side of that debate. I think enough people are looking at it that if it gets to that point, there's going to be some government oversight that'll step in and kind of come to the rescue.
Right. So good show today, Josh. We hammered through some great and amazing content. Tomorrow's Wednesday. We're going to be back with more information, and on Thursday we have Anna Kelly here, a great woman who is going to be talking to us about this. Anna started about 10 years ago with zero money in the bank and zero assets, and now has several hundred units. I forget if it's 2 or 3 or 500 units.
500 units.
500 units. She either has a controlling interest in or is a heavy investor in. She's an absolutely amazing woman. She did all of that while being a full-time employee, 4 kids running around to all kinds of games and schedules and stuff like that, and supporting her husband start his small business from the ground up. So I mean, Taz is exactly right. She is awesome. So she's going to be here on Thursday. You're going to want to check that out. Any other closing words or closing thoughts for us, Josh?
Yeah. So yesterday I got so excited about the real estate hackers event coming up in June. We're very, very hopeful that we're going to be open and ready to rock and roll at the end of June. However, I think it's really important to note that obviously we're testing the waters and making sure that everybody's going to be safe and obviously complying with all of the government regulations and during the shutdown. So, if you are looking at, coming to the event in late June, put it on your calendar with a pencil. We'll keep you updated on what's going on, and keep that in mind. But that's it. That's all I got for the day. If if you're looking for funding for your next deal, contact Hard Money Bankers. You can reach me directly, 717-213-8488. 717-213-8488. That's all I got for today. That's it.
Awesome, guys. Have yourself a great day, and we'll be back with another awesome show tomorrow.
Awesome. Thanks, guys. See ya.
See ya, everybody.